Most people think the world changes when the headline changes. I have learned that the real change starts long before that. It starts when the people with the most money stop trusting the system that made them rich. That is what I see now, and most people are reading it far too late. If you want to keep hearing how I think through moments like this, stay close, because the pattern I am about to walk through is the kind that only looks obvious after it has already rearranged your life. I am not talking about a normal market swing. I am not talking about one election, one rate cut, or one bad jobs report. I am talking about a slow break in the rules that shaped money, power, trade, and investing for decades. And when the rules change, the winners are rarely the people who react last. When I say a different world order, I do not mean some dramatic movie scene where everything ends in one day. I mean the operating system underneath the world economy starts to change. The old deals still exist on paper, but trust gets weaker. Trade still happens, but it becomes more political. Capital still moves, but it moves with fear. And the rich, especially the people who manage very large pools of money, start acting as if tomorrow will not look like yesterday. That shift is easy to miss because the surface still looks normal. Stocks can still hit highs. The dollar can still be strong. Bonds can still trade every day. But I have watched this enough times in history to know that stability at the top often hides stress underneath. The public sees prices. I look at incentives, debt, political conflict, and how countries treat one another when they are under pressure. The easy story says this is just another cycle. Inflation rose, central banks tightened, markets adjusted, and now people are waiting for the next rate move. That story is not false, it is just too small. It treats the system like a machine that only needs a tune-up. What I see is bigger than that. I see debt levels, internal conflict, and global rivalry rising together, and that combination has changed world orders before. I have spent a lot of my life studying how empires rise and decline. I did not study it as a hobby. I studied it because markets kept teaching me the same lesson. What feels new in the moment is often very old in structure. The names change, the flags change, the technology changes, but the mechanics repeat. Big debt, big wealth gaps, political anger, and conflict between leading powers have shown up together many times. That is why I pay attention when the richest investors, central banks, and sovereign wealth funds start making quiet changes. A sovereign wealth fund is simply a giant pool of money owned by a country. These people are not posting their feelings online. They are adjusting reserves, custody, exposures, and who they depend on. Those moves are not noise, they are a message. The message is simple. They still use the old system, but they trust it less. They still hold dollars, but they want more alternatives. They still buy bonds, but they worry about who controls the pipes of money. They still invest globally, but they are preparing for a world where access can be blocked, assets can be frozen, and trade can split into rival camps. That is not theory anymore. It is already in motion. If that sounds too abstract, think of it this way. Imagine I live in a neighborhood where one bank handles almost every paycheck, every mortgage, and every business loan. I may trust that bank for years, but if I start to worry that one day my account could be restricted, my first move is not to panic. My first move is to quietly open another account, move some savings, and reduce my dependence before the crowd notices. That is what countries and large investors do. They do not wait for the bridge to collapse. They start walking less weight across it. They build backup routes. They own more assets that do not depend on anyone else's promise. Gold matters in that kind of world for a simple reason. It is not someone else's liability. It is not a promise to pay. It is the asset itself. That helps explain one of the clearest signals I see. Central banks have bought more than 1,000 tons of gold in each of the last 3 years. For a long time before that, the average was closer to 400 to 500 tons a year. That is not a random spike. That is a change in behavior. And behavior matters more than opinion, because behavior reveals what people do when real money is on the line. The survey data around this is even more telling. In 2025, 95% of surveyed central banks said they expected global gold reserves to rise over the next year. 43% said they expected their own gold reserves to rise. 73% said they believed the share of US dollars in global reserves would be lower over the next 5 years. Those are not fringe voices. That is the reserve management world leaning in one direction. Now, I want to be careful here. This does not mean the dollar is finished. I think that is one of the biggest mistakes people make. They hear that the system is changing and they imagine the old leader disappears overnight. History almost never works like that. The dominant reserve currency stays dominant longer than most expect. Then, while people are staring at its size, its power slowly becomes more conditional. Right now, the dollar is still dominant by almost every major measure. About 58% of disclosed global foreign exchange reserves were still in dollars in 2024. Roughly half of international payments still run through the dollar, and in foreign exchange trading, it shows up in about 88% of transactions. That is a huge lead. So if you think I am saying the dollar loses its role tomorrow morning, I am not. But dominance and trust are not the same thing. A bridge can still carry traffic while cracks spread through the foundation. The reason people still use the dollar so much is not just love. It is network effect. It is habit. It is market depth. It is military reach. It is legal structure. It is the fact that huge parts of trade, debt, and banking were built around it over many decades. That kind of power fades slowly, then suddenly matters less than it used to. Ask yourself this: if the money system you rely on is still the biggest in the world, but the people running giant pools of capital are quietly buying insurance against it, what does that tell you about the future they are preparing for? That question matters more than the daily move in the S&P 500. It matters more than one inflation print because it goes to the heart of trust. Trust always sits on top of arithmetic. And the arithmetic in the United States is becoming harder to ignore. U.S. national debt reached about $37.64 trillion in 2025. A century ago, in 1925, it was about $380 billion. Of course, the economy is much larger now, which is why I look at debt relative to income, not just the raw number. But even on that basis, the burden is heavy and still climbing. Debt by itself is not always fatal. I have never believed that simply owing a lot means collapse is next. What matters is whether the debt can be serviced without destroying the value of the money, the health of the economy, or the political order. When a country borrows in its own currency, it has more flexibility, but that flexibility can become abuse. And when investors start sensing abuse, they demand protection. That is where people get confused about printing money. Printing money does not always mean trucks full of paper bills. It often means creating money and credit through the central bank and the banking system to support debt and liquidity. It feels painless at first. It can postpone pain. But over time, if it is used too much, it weakens trust in the value of money itself. Then people start looking for stores of value that sit outside the promise structure. I watched a version of this tension build after 2008, and I watched it intensify after 2020. When rates were near zero and large amounts of money were created, it helped support the system in the short run. But it also planted seeds. It pushed people out on the risk curve. That means investors had to take more risk just to try to maintain returns. It lifted asset prices, widened gaps, and made the system more dependent on easy money than most people wanted to admit. This is one reason the richest investors are not only thinking about return anymore, they are thinking about resilience. Resilience means being able to survive different environments without making a heroic guess about the future. At my firm, I spent decades thinking this way. I did not want a portfolio that only worked if growth was strong and inflation stayed calm. I wanted something that could live through rising inflation, falling growth, policy shocks, and devaluations. That way of thinking matters now more than ever. The old world rewarded concentration in one system. If you owned US stocks, US bonds, and dollar cash, you felt diversified because those markets were big and liquid. In the world that may be coming, that kind of diversification can turn out to be shallow. If one political and monetary system is the hidden driver behind all three, then you are more exposed than you think. And this is where the phrase different world order becomes real. The post-World War II order was built on American economic power, military power, and financial power. In 1971, the United States closed the gold window. That means foreign holders of dollars could no longer convert them into gold at $35 an ounce. The world kept moving, but the monetary system changed. It was a reminder that when pressure rises, rules can be rewritten. I think many people forget that point. They assume the rules are permanent because they have lived under them for a long time. But rules in finance are often temporary expressions of power. When the balance of power changes, the rules change too, sometimes through law, sometimes through crisis, sometimes through quiet workarounds that grow until the old rule is still spoken about but no longer obeyed in full. If this line of thinking is sharpening how you see your own money, stay with me. The goal is not fear. The goal is to stop confusing familiarity with safety. Those are not the same thing, especially late in a cycle. Now let me widen the lens. A world order does not change only because of debt. It changes when debt problems meet internal disorder and external rivalry. Internal disorder means the country becomes more divided over wealth, values, and who should bear the cost of adjustment. External rivalry means a rising power challenges the existing one. When those two forces show up at the same time, financial conflict becomes much more likely. Financial conflict is not always tanks and missiles. Sometimes it is sanctions. Sometimes it is tariffs. Sometimes it is export controls, block technology, frozen reserves, restrictions on capital movement, or pressure on payment systems. I recently warned that the world is getting close to what I would call a capital war. That means money itself becomes a weapon. Access to markets, custody, payments, and financing becomes part of geopolitical leverage. Once that risk enters the minds of leaders, portfolios change. It does not matter whether those restrictions happen next month or not. The possibility alone alters behavior. If I am a country that might be sanctioned, I want more assets I control directly. If I am allied with a country that can freeze assets, I may still ask myself how far that power could reach one day. Dependence starts to feel like vulnerability. That is why even allies think harder now about strategic autonomy. Strategic autonomy is just a simple phrase for not wanting all of your key systems controlled by someone else. We can see it in energy, supply chains, semiconductors, defense, and finance. The same logic that drives a country to secure chip supply or energy supply can also drive it to rethink reserve assets, custody locations, and exposure to foreign debt markets. There is also a mechanical truth that many people miss. Trade imbalances and capital flows are two sides of the same coin. If one country runs a large trade deficit, it usually means money flows back into its financial assets. For years, that supported the United States. Foreign countries sold goods, earned dollars, and recycled many of those dollars into US bonds and other assets. That arrangement looked stable until politics started treating economic ties as a source of pressure. Here is a striking example. European investors accounted for about 80% of foreign purchases of US treasuries during part of 2025. That shows the demand is still there, but it also shows concentration. When funding needs are large, the identity and psychology of the buyer matter. If foreign demand becomes more conditional, then financing large deficits becomes more fragile, even if nothing breaks all at once. A skeptic might say, I am overcomplicating it. They might say the United States is still the cleanest dirty shirt in the laundry basket. And frankly, there is truth in that. Europe has its own problems. China has its own debt and property issues. Many emerging countries do not have the scale, legal depth, or trust to replace the dollar system. If I were forced to choose the strongest house in a weak neighborhood, I can see why many still choose America. But that objection misses the point. The question is not whether there is a perfect replacement. The question is whether rational actors are reducing single-point dependence on the current center. History does not require one rival to become instantly better at everything. It only requires enough actors to seek backups, alternatives, and buffers. Change often comes through diversification before it comes through displacement. I saw this logic clearly when I studied earlier shifts in empire. The British pound did not die in one dramatic week. Britain weakened through debt, conflict, and loss of relative power over time. The United States rose through productivity, financial depth, and wartime strength. The handoff was long, uneven, and full of periods when old prestige hid new weakness. That is how big transitions usually feel from the inside. Confusing at first, obvious later. The 1930s offer another lesson. Debt stress, inequality, domestic conflict, and protectionism fed off one another. Smoot-Hawley, the big U.S. tariff law of 1930, became a symbol of a wider breakdown in cooperation. I am not saying history repeats in exact form. It never does, but it rhymes in structure. When countries turn inward under economic pressure, financial and political conflict tend to rise together. That is why I keep coming back to incentives. If debt is high, growth is weaker, and voters are angry, leaders have limited options. They can cut spending and take pain now. They can tax more and fight over who pays. They can repress rates, which means holding interest rates below what markets might naturally demand. Or they can let the value of money erode gradually. None of those choices is politically easy. All of them change investing. So what are the richest investors doing in response? They are not all making the same bet, and that is important. Some are buying gold. Some are owning more real assets, which means things tied to the physical world, like infrastructure, commodities, and selected land. Some are shifting part of their capital toward regions that may benefit from supply chain rewiring. Some are shortening duration, which means reducing exposure to long-term bonds that get hit hard when inflation or yields rise. Some are also holding more optionality. Optionality means having flexibility so you are not trapped if conditions change fast. Cash can be part of that. So can liquid hedges. So can owning things across different legal systems and political zones. The key is not one magical asset. The key is understanding that the old habit of maximum efficiency is giving way to a new habit of controlled redundancy. In plain English, serious money is paying more for backup plans. Let me make this personal for a moment. If I were a normal saver with a paycheck, a mortgage, and a retirement account, I would not try to outsmart every headline. I would not turn my life into a bunker. But I also would not assume that a 60-40 portfolio built for the last world automatically fits the next one. I would ask a more basic question. What environments am I truly prepared for, and which ones would hit me harder than I think? Would I be okay if inflation stays stickier than expected? Would I be okay if growth slows while prices stay high? Would I be okay if bonds do not protect me the way they used to? Would I be okay if politics start shaping markets more directly? Those are not extreme questions now. They are normal questions for a mature investor in a changing era. What would happen to your plan if the asset you call safe turns out to be safe only in one kind of world? That is the question I would urge you to sit with, because most financial pain does not come from what we know is risky. It comes from what we wrongly assume is protected. From here, I can see at least three broad paths. The first is a slow burn adjustment. In that path, the dollar remains dominant, but reserve managers keep diversifying, trade blocks deepen, and investors demand higher compensation for lending long-term to governments with large deficits. Nothing explodes, but returns become harder, policy matters more, and simple index comfort gives way to more uneven outcomes. The second path is a policy break. That could come from a sharp rise in deficits, a funding scare, a recession that forces aggressive easing, or a geopolitical shock that triggers capital controls or sanctions with wider spillover. In that world, the move from trust to protection happens faster. Gold, cash management, legal jurisdiction, and counterparty risk all move from boring topics to central topics very quickly. The third path is the most constructive, even if it is the least likely in the short run. That would mean leaders choose reform before crisis forces it. It would mean more fiscal discipline, more realistic pricing of promises, less political theater, and some rebuilding of trust between major powers. I never rule that out, but I have been around long enough to know that systems under pressure usually choose the easier road first and the wiser road later. So where does that leave me? It leaves me where I have often tried to stand, which is in reality rather than ideology. I do not need the world to collapse to see that the incentives are changing. I do not need the dollar to disappear to know that reserve behavior is shifting. I do not need every investor to agree with me to notice that the largest and most careful pools of capital are preparing for more fragmentation, more politicization, and less blind trust. And that is the deeper warning in the title. The richest investors are not preparing for one trade. They are preparing for a different map. A map where money is more political, where diversification has to be deeper, where neutrality has value, and where owning some assets outside the promised structure matters more than it did in the easy years. That does not mean panic. It means adaptation. If you take one practical idea from all of this, let it be this. Do not build your future on a single story about how the world is supposed to work. Build for a range of environments. Keep some humility in your forecasts. Own some balance. Respect debt. Respect politics. Respect history. And never confuse the longest running system with an unbreakable one. I have learned that world orders do not usually end with a bell ringing. They fade, split, bend, and then one day people wake up and realize the old assumptions no longer protect them. By then, the smartest capital has already moved from confidence to preparation. That is why I pay attention now, not later. The people who stay safe in great shifts are rarely the people with the boldest opinions. They are the people with the deepest preparation. And in times like this, preparation is not paranoia. It is wisdom before the crowd gives it a name.